Hi, once again, everybody. Welcome back to the Comstock channel. I'm Marlin Bowling with you. Thanks for joining us. I have Joe Camp with me. He is with Comstock Investments. I want to encourage you to like this video and click on that bell icon down below to subscribe. That way you'll get notified when we have new updates and help us grow. Make sure you share this video with others as well. We appreciate all the help and we continue to grow each and every day thanks to your help. Joe, let's review Wednesday's ag commodity trade. And, you kind of have to look far and wide to find much that was a positive number on the close in the ag trade. Let's start on the grains here. It seemed like the weakest link, if you were, would be the wheat market. It seemed like it closed almost on the low of the day. What's the problem there?
Looking at better weather ahead, hopefully both for the southern plains, as we have showers in the forecast for this 2-week outlook ahead. It's been dry, of course, in conversation about drought once again expanding across states like Texas, Oklahoma, and Kansas, where winter wheat crop conditions have reversed slightly, albeit from strong levels relative to a year ago. Concerns still extending from a cold spell on some of that crop that maybe put to question yield potential going forward, but a reversal of that here today because of the forecast. And I mentioned not only for the southern plains, but also for Russia. Of course, a big player here, one that we've talked about being a real source of pressure on the overall wheat market, as cheap as prices have been in Russia. There were some signs of a bottoming here lately, but mostly back lower here all of a sudden this week, with talk about that country also receiving some timely rains in these next few days ahead. So some backtracking here for wheat and for most markets. We see soybeans the lone winner of the grains today, and that would be a rebound from 2 hard down days to start the week. Corn a bit caught in the middle, but we can talk about the livestock too, flipping and reversing from how they started the week, and outside markets similarly back and forth. And that's just the type of trade we're still in here, where it's a couple days up, but not 3-4 days in a row. It's not a trendy type of market for sure, and that doesn't apply to just the grains. It's almost everything here.
You mentioned the weather outlook, and you have the 8 to 14 day precip outlook that was provided by the Weather Service here. And let's take a look at that. On that map, it shows a big area of above normal moisture expected for what has been part of the driest part of the country. That would be the Southwest, the Four Corners area, and also the entire high plains region there in the central U.S. That obviously put pressure on the wheat trade, but it looks like even the entire Midwest is set to get maybe a little bit above normal moisture, or at least some decent moisture over the next couple of weeks. And that probably is going to keep some pressure on that corn market too, isn't it?
Looks like it, because you also pair that wetter than average forecast with a warmer than average one for most of the country as well. So it's not just that we're going to turn stormy and cold again, but rather we're still seeing a steady increase in soil temperatures and some showers that are really welcomed by all accounts by those that are receiving them. And that starts with the southern plains, as we talked about, for the wheat crop there, and for newly planted corn crops like in Texas. We see that across the Midwest. It's a trade-off, as always, this time of the year, where it may be delaying the early start of those planting efforts, but it's only one day now into the second half of April, and so it's not by any means too late for growers around here in the middle of the country. And the trade-off is, again, those welcomed rains that resupply soil moisture after what had been a really dry trend heading into the first couple days of spring. And then that recent shift really setting us up much better going into the new season. Now, it can be something that extends into talk about concern over delays, but that's not until we get a couple of weeks out or more. We could talk a little bit about that still persisting as an issue in the southern delta, where they've been inundated with rain here lately. But you look at that forecast map and you just don't have much insofar as alarm for this market to really chew on, or to convince these bearish speculators to do more short covering. And so the weather, as always, at this time of the year is a huge factor, and one that I'd call mostly favorable and therefore a bit negative for markets.
So another thing that kind of took the corn market out at the knees, I guess I would say, on Wednesday was the total energy complex just kind of collapsing on Wednesday. What was that about, and what's the correlation there?
You always look at crude oil for guidance, and it's not uh, one just because of these direct links to the processing sector that we have for corn and corn-based ethanol and soybeans and soy-based renewable diesel. Those are really big storylines, and they're going to continue to be, I think, a source of support overall for this market. But all of a sudden, on a day like today, you have such a sharp sell-off for crude oil. Also, relatedly, a weaker report for ethanol. And you have on top of that a shift or an outflow of money capital leaving these energy markets, and then also weighing on the broader commodity space, because again, it's not just the direct tie to processing, but it's also crude and its broader leadership for the market, where you have investors seeing crude rally and then wanting to snap up other commodities as well, or crude leading a commodity index higher that would also be diversified with other agricultural commodities, for example. So that crude tanked like it did so hard today, down more than $2 a barrel for nearby WTI futures. You see some related pressure on the overall market. And again, we bring up the ethanol stocks report. We had production quite a bit lower here, stocks not down all that much here at the same time. And so we've all of a sudden fallen below these year ago levels, and potentially also under where we need to be to meet the USDA's forecast. I did include a chart that we're going to show readers about ethanol production and where it is at relative to the USDA forecast, because that's important, particularly coming off last week where the USDA did make a raise for ethanol production, but they still left room where traders were out there thinking we could have more to go in terms of ethanol going up, and that being a source of reduction for stocks going forward. But we need to not see any more reports like this ahead as we finish up this marketing year for ethanol. But that was definitely one of the more negative influences today, was that crude oil sell-off.
Yeah, and that ethanol graph that you're describing here, we can look at that on the screen here. It has such jagged moves to it. I mean, it seems like there's not a lot of consistency to the output there. What do you attribute that to anyway?
I think fluctuating margins, certainly the way that crude oil act, it's a futures market that puts off signals to these ethanol plants on whether or not they should run full force, full capacity, or back off a bit. And lately, here we've seen them want to back off just a bit because margins have been pinched on this recent turn lower for the broader energy market that we've talked about. Now, it's still something ahead that can reverse into a more friendly influence like it had been until just recently. We still have crude oil in the low $80s per barrel mark, and calls for it to rally up to $95 or $100 a barrel again later this summer when we have motor gasoline consumption in full force. So we'll watch that. It could certainly flip, as you note, because it's so jagged up and down, where if this week's negative, we can very well be talking about it as a bullish influence going forward. And in fact, it was just again last week that you and I were talking and showing the basis map and linking really strong basis, particularly in the Western Corn Belt, to what we're still seeing in positive draw from the ethanol plants out there. And that's not something that'll go away here anytime soon. It's also something that's sensitive to policy announcements. We're waiting on the White House to give us more guidance on how ethanol is going to be scored and its usage for sustainable aviation fuel. We had some news out here recently that we've got a partnership agreement with Japan to include ethanol in some sustainable aviation fuel production going forward between the two countries. So there's a lot to be positive about, just not today, not following this most recent report.
And we have to keep in mind the crude oil market itself, as we all know, is very fickle. I mean, it can turn on a dime, and yeah, it sold off because after the Iranian attack on Israel, there was a big fear of retaliation, and nothing has happened yet. So it seemed like the market really deflated for a couple of days just because nothing happened. But on the other hand, if something happens, that could all turn within 10 minutes time, right?
Right. That's also a huge influence because we are reminded of how we finished last week so strong on the grains because at the same time, crude oil was rallying. We also had the dollar higher, like we don't see often. We talked about that before the conversation started. Normally, a higher dollar is going to weigh on the commodity space. But in fact, we had the dollar rallying along with crude oil, gold, most agricultural commodities to close last week, and that's because of risk premium entering the market in relation to these global security risks. And so the dollars are rallying as a flight to quality, a safe haven move into the greenback. You've got crude oil and its obvious link to the Middle East and Iran, such a big producer and exporter. And then you have gold and just this idea about if we're going to have a more widespread war, we need to be in assets that are going to be protected from what can still also be an ongoing inflation issue. And so today it's a relief of some sort that over the weekend, that skirmish, that offensive by Iran didn't turn to anything bigger. But you said it. I mean, we were still waiting for the next shoe to potentially drop insofar as Israel's threat now to retaliate against Iran. And so what could be ahead there is an unknown for the market that I think for now limits the downside of some of these bigger markets and does in the future, again, provide the potential spark for the broader commodity space to be higher later this summer.
Well, we were talking about the fact that the livestock trade was kind of flat actually on Wednesday after making really big moves here, up and down here over the past week or so. Now, I wanted to get your take on why the market was so quiet on Wednesday. And also, I understand you have some more information about some new cold storage numbers.
Well, 2 days up for the market to start the week, cattle futures after another rough close last week. That was a win here, that we've got these fears easing to a big extent over avian influenza, still something we're going to have to monitor closely, but really a market that had reset, speculative liquidation, those traders rushed for the exits, and then we had a board that was heavily discounted to cash markets that held resilient for the most part because of what the fundamentals still reflect in short fed cattle supplies and strong demand, any way you look at it. But you get into today's session, because nothing's straight up or straight down in this kind of market, there is some give back after that early week run. It also fits with the same thing we bring up for the grains and the rest of the commodity space. You look at these outside financial markets on a day where the stock market's looking a little bit nervous, where there's some overall fear about the health of the economy going forward, about inflation still being a persistent issue. That's what's going to pump the brakes on some of the bullishness here overall for cattle and the livestock market as a whole. And so for those cold storage charts, that's the fundamental bullishness for both cattle and hogs. I bring up beef in cold storage on the last report and pork in cold storage on the last report. Both of those numbers were down 12% from a year ago. And you can see that the start of 2024 for beef and pork coming in much lower than in recent years and 12% lower than a year ago for both counts. And that at the end of the day is a strong number. We talk about the hogs and pigs numbers and all these revisions and the uncertainty there. You can talk about a cattle inventory report now that we're down to one a year and how hard those numbers are to peg. These are really strong statistics when we are able to count what's actually stacked up in cold storage. And so at the end of the day, that's what's left with production when you factor in weights and slaughters and overall production growth here to date. We're starting off the summer season at relatively low levels, and that's what's still bullish about these markets. Again, the caveat, though, like we had a little bit of a reminder of today, is that if we start to get worried about inflation again and about consumers pushing back, at relatively higher prices, that's going to limit the bullish enthusiasm and still be a potential weight on the market in terms of speculative positioning. So a little bit lower across the board for these livestock futures on Wednesday.
Well, okay. So if you're a livestock producer out there, and here we're looking at corn just kind of dragging the bottom of the barrel all the time, it can't really get any traction. But we're just now starting the growing season, and it seems like you always have at least a couple episodes where there are thoughts that maybe the crop is getting killed off. And usually you'll get some sort of a spike along the way. If you're a livestock producer, is this a prime opportunity to lock in some feed needs for this year?
It does feel like we're in a window where those producers should be looking to hedge their feed needs because of exactly what you just outlined there. The fact that we're telling grain producers to be patient on sales, right? Because it's normally not until you get into these months of May or June, early July, that we start to have a run up into early summer highs that are attached to whatever weather scare out there, production risk that always seems to pop up seasonally. It's before that run up that we'd want these cattle producers in particular to take a look at their feed needs. I think this similar, a bit of advice could be said for those feeding soy meal as well. This is a market that's dropped here over these past a couple of weeks and now provides value before what we could still potentially see as a seasonal run up for grain prices over these next several weeks.
All right. Well, Joe, great information. Thank you as always. Look forward to talking with you again next time. That's Joe Camp of Comstock Investments with us, and I hope you enjoyed the information here in today's episode. And appreciate you giving a little time to check this out. For producer Brian Hendrickson, I'm Marlin Bowling. We will catch you next time on the Comstock Channel.
Thanks for joining us on our Comstock YouTube channel. Don't forget, you can also find us on Facebook and TikTok as well. Futures trading involves risk. The risk of loss in trading futures and or options is substantial, and each investor and or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.